After getting skills of calculating discounted present value of business or asset, the next that you could be useful in choosing the best investment option are the financial indicators like net present value, internal rate of return, and payback period. The NPV is a difference between the present value of money that you receive from investment and the present value of money invested into this business over some period of time. This formula is used to calculate NPV. Here is an easier way to remember the concept of NPV. NPV is today's value of expected money you get minus today's value of invested money in some business or asset type. The investment with a positive NPV is considered as profitable, and an investment with negative NPV is not acceptable, as it gives no money. Assume you are going to invest your money in some production equipment and you wonder whether this investment is profitable or not. You got information from an accountant that an annual profit the equipment and at the end of each month is $25,000. And you got this asset to use for 60 months and equipment is expected to earn 0.84% per month. The first 5 payments are illustrated in this table. In this case, the NPV is positive. The equipment should be purchased. And now, let's talk about the use of internal rate of return. The simple economic meaning of this indicator is that it shows an average annual rate of return you'll receive from this investment or asset in considered time horizon. For instance, if investment is considered for months and makes 0.84% of return, then it means that this investment will give you on average 0.64% return per month through 60 months period. In other words, it is discount rate at which the NPV is equal to 0. For example, if you borrow money from bank at 1% per 1 year, then you should not invest them in asset. Could be a project which gives you only 0.84% of income. And it is better to invest them in some other which give more than 1%. Or it is effectively if you borrow money under 1%. If your IRR is higher than 1% in this case, you'll pay off your debt and earn extra profit. How to calculate the IRR? Doing it by hand, it's not easy. It is necessary to have real mathematical abilities, as IRR is calculated by trying different rates and finding the rate at which NPV is equal to 0. You need to make several replications before you find the internal rate of return. Difficult, very difficult. Microsoft Excel considers IRR instantly through the IRR function, as easy as shelling peers. This function will be used in your face-to-face session in the example of real case. There is a third important indicator of investment into business. It is a payback period. The economic sense of this indicator is very simple. It is a period of time in which your business covers all your initial costs of starting business. As a rule, a small payback period is more preferable. And the calculation is easy, just subtracting each annual money from initial amount you invested into business until the payback period has been achieved. There is a rule in a business that higher the risk, higher the return. More risky projects, for example, an absolutely new type of startup business, has high risk, as nobody knows whether this will work or not. And it is possible to expect higher profit as nobody will repeat it, knowing nothing about this business. Your idea will be unique and interesting for customers. As we understood, different investors with different risk levels invest in different projects. Some are ready to invest in risky businesses, while others are risk-averse and prefer risk-free investments.